Chris Vermeulen joins us today. He is a chief market strategist at thetechnicaltraders.com, and we'll be talking about this consolidation pattern that we've seen in the markets. It's due for a breakout, but is it due for a breakout to the downside or the upside? And which sector should you pay attention to the most? This is the theme of our discussion. Welcome to the show. Chris, welcome back. Always good to see you.
Hey, thanks for having me, David. Always a pleasure.
We're speaking today on Wednesday, a bit flat on the S&P 500, up about 50 basis points. Overall, over the last month or so, we've seen this consolidation pattern. The S&P is up about 7-8% since its March lows, but for the last month, it's been flat. It's been trading range-bound. What is it waiting for exactly, Chris?
Yeah, I mean, the stock market, I think, is waiting for the next piece of news, the next hammer to drop to see which way it's going to go. We've also obviously just gone through kind of first wave of the banking systems kind of showing its weakness and having some bankruptcies there. But right now, I think we're waiting on the debt ceiling. If we take a look at the charts, we've got the SP 500 futures here, and the market's kind of put in a short-term low in March. They've had a nice about 8% rally. And now we've been trading sideways for a month and a half, and the market really is just treading water here. No one's really committing in any kind of direction. Where is it going to break out to? I mean, ideally, I'd like to see it break to the upside. We do have a series of higher lows. We've got a series of more or less higher highs, and we're kind of testing at this resistance area through here. This is seen as like a bull flag pattern. It's consolidating. The overall trend is up. The moving averages are moving up. So if this plays out according to the current trend, the underlying trend at play, it should resolve to the upside, and we could see another big push higher. And a lot of people, I think, are, getting a little nervous. We're starting to see some money really swish-swash around over the past couple of weeks. We keep seeing money rotate into defensive sectors and then into growth sectors. And really, that's been happening for about a month and a half. And so it's really hard to get a gauge here. At this point, it's a consolidation. I think it's going to break to the upside. And I think we're going to see a lot of people start covering their shorts. It could be a fairly powerful rally. Might only last a few days, but percentage-wise, it could be a very strong rally and move us up another 4, 5, 6% in the markets and kind of create a short squeeze. Get everybody who's been betting on the downside, expecting this to run out of steam here and roll over, to get them out of the market and get people long. And then, of course, maybe from there, the market might start to pull back and roll over. The market always has a way to hurt the most amount of people possible, especially short-term traders. So I'm expecting this to resolve to the upside based on the current price action and trends at play here.
Chris, traders today are pricing in a resolution to the debt ceiling deal sooner rather than later, it seems, because the markets are up. Generally speaking, do you let these events dictate your trades and your outlook? Presumably, I mean, this is a Black Swan event, but it's interesting to see how the credit default swaps have risen, which means that traders, especially fixed income traders, have priced in a small possibility of a U.S. debt default, which would be catastrophic and unheard of.
Mm-hmm. No, so I don't let any of these events work themselves into the trades. I don't change my strategies. I don't exit positions or enter new positions because I think something is going to happen. I think trading around news is one of the kind of worst things to do, because all you're doing is you're guessing on something working out. They're all just guesses. And, as a technical trader, I'm following price. And so this whole debt ceiling, I think the world is waiting to see what's going to happen. I think there's a possibility this Black Swan event could happen. And if it does, it's going to affect, the majority of investors, because the reality is most investors, I believe, have Stockholm syndrome. And that is more or less they have a connection to kind of they're really become the victim here. The average investor listens to what the financial industry has been teaching us and telling us, which is to buy and hold and diversify and just turn a blind eye to corrections and ride that roller coaster, but you'll be fine, right? And so if we do get this default, the average investor is just going to sit there and watch and panic and freak out when their accounts drop, versus somebody who's like an active trader who actually has, protection in place, meaning you have a protective stop. So if the markets start to have this Black Swan event and start to crash, just like what happened with COVID, we were able as an active investor to profit handsomely during these Black Swan events, because when price starts to fall, our strategy automatically kicks us out of the trades because we have stops in order. So we don't even need to be around. And then, of course, if we move out of one asset, we're always looking, what's the next asset we can get in that's favorable during this type of condition, and we can ride those moves. And so if we do get this Black Swan event that you just mentioned, David, most investors around the world are going to suffer because they are stuck with this belief that the buy and hold is the best long-term strategy. It's the only really viable way to survive long-term. But to me, it's like the worst possible scenario for somebody like 45 plus or already retired, because you could lose 30, 40, 50. Some people are calling for an 80% correction in these markets. And it couldn't happen at a worse time when you're just about to retire or already retired. So you got to be really aware of this. I don't think it's going to happen, but I mean, you need to have some protection in place that if it does, it's way better to step on the sidelines.
Well, that's the issue. So let's assign a 1% probability to a debt default because a debt ceiling isn't raised. Let's just say it's a 1% probability, but that 1% will wipe out every single position that you have. So in that scenario, do you just ignore the 1% and say, look, this is a low probability event, let's ignore it, and just assume that the 99% will take hold and everything will be fine? And so essentially you're not hedging on a very low probability event, but that low probability event could completely destroy your portfolio forever. What do you do?
Right. So believe it or not, it doesn't matter if it's 100% chance it's going to happen or it's never going to happen. You still do the exact same thing. You put your money into an asset, and then you put protective orders in place. It doesn't matter if the market corrects or not. You need to always be protected in case something happens. So you'll put, say, for example, say you put a 5% stop loss order on your investments. If the market rolls over from here and starts to go down 5%, it's going to exit you out of those trades, and you're going to be able to avoid that whole catastrophe. And now that is something you should have in place no matter what. It doesn't matter if it's going to happen. You need to be protected to the downside. And so as a technical trader, it really doesn't matter what the market does. All we do is we identify a trend, we get into play. When that trend is confirmed that it's failed, one of these protective stops kicks us out of the trade. So it's not like you need to do any type of hedging. You mentioned, how do you hedge for it? Well, I don't believe in hedging because hedging is really expensive. You've got to buy all these expensive different types of options or contracts or positions that are a high cost to produce. But instead of hedging, you can just move to cash or find an asset that's going to benefit for this new trend that will go up. So that's the real key. Is hedging is expensive. There's a lot of ETFs out there that make people feel good, like covered call ETFs. They've got hedged ETFs. They've got all-in-one ETFs. They're all just fancy ways the financial industry just tries to repackage things to make people feel like they're protected. And if you actually look at all those different ETFs, they dramatically underperform. And when there's a Black Swan event, you usually lose really bad. And then when the market does recover, there is no recovery in those type of plays. They're very, very small. So, whether there's a 1% chance or a 100% chance, you should have the exact same strategy in play. If the trend turns down, you get out and you find an asset that's going up. It's really that simple. And I don't believe in the buy and hold. It's just a really great way to have status quo results and ride that roller coaster.
Just to clarify, when you say cash, do you mean just cash in your bank account, or are you putting it into CDs or short-term maturity assets, treasuries?
You can literally just move to cash. Like, for example, like you can move to Interactive Brokers and literally sell all your positions and sit with a cash balance. And Interactive Brokers pays you like 4.5%, 5% interest. You could move to an ETF that is like a BIL, BIL is the symbol. It's just a 1 to 3 month treasury note. You get paid interest or dividends every month. So literally just move to cash, let the stock and bond market and commodities collapse and collect a little bit of interest. And really, you're just be sitting there licking your lips, getting excited like, hey, a correction is good for those who can take advantage of it and watch it happen or benefit from the drop itself. So there's nothing wrong with cash in this type of market condition. In a raging bull market, you want to be invested, but we're not in one of those. And it's way better to protect your capital than it is to just hope that it's going to go up and hope that there's no big correction, right? That's a terrible strategy.
There's people who would deploy all their capital and just have upside as well as downside. Maybe they buy a stock and maybe they have a covered call on that. Some people don't even have covered calls; they just have naked calls. That's a different story. Other people would buy a call and a put. Either way, there's this mentality out there that you have to be 100% deployed all the time, and you just have to hedge yourself. You said it's expensive, but people do that anyway. So what would you say to somebody who says to you, Chris, the fact that you have a lot of cash shows you have low conviction? How would you respond to that?
Yeah, so there's a lot of different ways to trade. And when it comes to options, I mean, it's endless. So if you are an advanced options trader, and one of my good friends is an advanced options trader, and they trade millions and millions of dollars in options, and they do advanced strategies where they're selling premium, they're profiting from volatility, they're profiting from time decay. So those are great strategies, but you need like a level 3 trading account. You need to be on it, and you're constantly rotating lots of positions. You're spread over multiple different options, contracts, and assets. So it is totally possible. From my point of view, I like to keep things as simple as possible. I think being 100% deployed all the time, I don't think it's the best solution. Maybe with options you can do it, because even if you take a loss with options, you can just keep rolling contracts, and you can literally trade options and almost never lose. But you might have to roll a losing position and keep collecting in that time decay, that theta, for months and months. I think cash is a great opportunity to recalibrate. Sometimes there isn't really a good low risk, low volatility play, and cash is the only way to just kind of step aside, let the markets kind of recalibrate, pick up a new trend, and then you can redeploy your capital in whichever asset is moving. So, cash to me is a very strong position. We're in it quite a bit throughout the year. Probably about 4 months of the year we'll be sitting in cash between being long positions and waiting for a new position. And it's just the way we kind of navigate, because my focus is on protecting capital. And then when there's a safe opportunity to invest it, we move to that asset. And I think a big chunk of this is I grew up, my parents ended up going bankrupt. They're entrepreneurs, but we went bankrupt when I was a teenager. And so we were living high. We had a very good lifestyle. And then we went right to the bottom with nothing but like our clothes and furniture. And that was like devastating, depressing, stressful, embarrassing. And so I learned at a young age, living at home, I'm like, you could lose everything at any time if you don't protect your capital. And then on top of that, I ended up getting my pilot's license. I started flying when I was 14, got my license at 16. And if you know anything about pilots, everything comes down to checklists. You have to have systems in place, follow the checklist, or you could literally crash and burn. So knowing that I could always lose everything if I don't protect it, knowing that you need systems in place, those were like the best 2 lessons I learned at a young age. That is why my whole strategy works so well, is because all I do is focus on preserving my lifestyle, preserving my capital. And then when the market's got nice, clean, low risk opportunities, we move our money in and we catch those moves. And we've got systems in place to kick us out if for some reason those trades don't work out or there's a black swan event. So that is like where my whole philosophy is based around. It's all about preserving our lifestyle and our capital. And if we do that, the profits take care of themselves. I mean, we've got very strong gains by being a technical trader, following trends and then standing aside when there is no clear direction.
I understand your philosophy. I'm just curious as to at what point in your career you decided to execute on that philosophy using the strategies that you have today. Meaning, why didn't you become an options trader? Or why didn't you trade individual stocks? Why don't you day trade? You have a swing trading style with futures on the indices. So what made you establish this kind of strategy?
Oh, good question. So I've done all those. So I grew up, I originally started trading stocks, small cap stocks. I loved it. It's super aggressive. I was kind of just doing a hybrid of fundamentals and technical analysis. And I was doing a lot of covered calls back then as well. I'd buy the shares, do the covered calls. And this was back in the late 90s. And it worked amazing. And then eventually we got into the tech bubble. And even if I bought companies that were growing on a fundamental basis, I still lost like 30, 50, 80%. They just fell in value. And I learned that fundamentals to me don't work. Even if there's a strong company, if you're in a bear market, it's still getting sucked down. So I ditched fundamental trading, and I started to get into ETFs more so over that time frame. I also started trading futures. I was day trading. I traded Forex. I'm the kind of guy who, my philosophy is I always wanted to be a CEO of a company, and I always wanted to go to a company and work in the warehouse, work my way up so I know all the aspects. And so I took that same premise to the stock market. I have done all the different styles of investing and active trading and different asset classes, from options and futures and day trading and all those things, Forex. And then I just came to the conclusion, I'm like, okay, day trading's a job. It's really busy. It's a never ending grind. It's really tough to make it long term. I just slowly kind of wound myself backwards going, okay, what is the least I can trade that I'm still engaged? I can catch most of the major swings each year, and that I can trade all my money in these positions versus watching a whole bunch of stocks and sectors and all that stuff. I just want to be able to invest in the best asset and just keep rotating my money from one asset to the next. As one falls out of favor, I move into the next. And so that's where I moved into ETFs, and I moved into kind of this swing/position trading, where trades can last a couple of weeks and they can last about 8 months. And you never know how long the market's going to trend, but I've kind of done all those things, and I want to live life more. I like to play. I've got the two young kids, 11 and 13. I mean, I can feel myself getting older, getting injured now whenever I do stuff, which is crazy. It's kind of scary. So I love the strategy I trade because I can check each morning. I know if we're going to have a trade probably in the next couple of days. I can also tell if we're going to have a trade. We won't have a trade for several weeks. And I tell subscribers this, I'm like, we're good. We can just watch the markets and learn and let them unfold. And when the new trade comes on, we'll get into those positions. But everybody gets caught up in always wanting to be in the markets, always wanting to have a lot of trades. And that's just not what I want to do. I want to trade and manage large sums of capital with the lowest risk and the fewest trades that I need to do, right?
Mm-hmm. Let's go back to the charts then, Chris, and close us off on the S&P with your outlook. We've talked several times before about your outlook on the S&P, and your medium to long-term stance is bullish because of the cycle that we're in. Some would say that if you've been sitting in cash, Chris, you've missed out on the shorter-term rallies. Does that change your outlook at all whenever we have a bounce in the markets and you're in cash? You don't have the desire to FOMO back in, as they say.
Yeah. I mean, most people have FOMO if they see the market rallying without them. The reality is, let me pull up a long-term chart and a short-term chart of the SP 500. So the top chart is going back to 2021. We can see the COVID crash. It's the weekly chart. The bottom here is my more active trading strategy. And during a raging bull market, we can catch beautiful long trades that last several months. We can grow our accounts by leaps and bounds. During COVID, I mean, we crushed it during COVID. We got out near the top. We made about 20% return on TLT on the bond trade. And I mean, it was an amazing opportunity because we have systems in place. And right now, the market is flatline. I mean, it is putting in what I think is a major topping phase. It might still work itself a little higher. But if you look down here, if you have to manage risk, and this is what a lot of people don't fully understand, they don't have the proper expectations from the markets. And they're usually looking at a short-term time frame. So if we see the market have a big rally, they think it should have been traded. We should have made money. But based on the style of trading that I do, yeah, it would be nice to try and catch all of these. All we have to do is just manage our risk through these periods. And these periods here, like right now, for example, the stock market is up for the year. Our strategy, we're relatively flat for the year. And people are like, well, we're missing out on the move. I'm like, but that's not the point. When you manage risk, this is the key point. When you manage your risk, the stock market's going to outperform you, usually near the top and near a bottom. You don't know where those are, and you need the major trends and the shorter term trends to confirm. So there's always going to be a point where the market is making more than you are, which it is right now. But once things kick into gear, we can surpass and crush it and do very well. Whether it goes up or down, it doesn't matter. We just need a big trend. And so we're in this phase right now where I don't get FOMO. I'm so tired of everybody wanting to always be in trades. I don't even want to be in trades. I just literally want to, when we get into a trade, I play it. I'm very, very emotionless now. I think I deal with emotions of so many thousands of traders around the world that, I mean, I'm pretty numb to it now.
Well, I think to challenge one's thesis, if I were to present to you a bull case, let's say that by the end of the year, I don't know, let's say the Federal Reserve decides to reverse course, pivot, cut rates, or we see the economy not heading into a recession if we're not already in one, and we see significant economic recoveries in certain sectors. Basically, I'm presenting you with bull case scenarios. Would you change your position? Would you change your outlook on the longer term bear market?
I mean, the only thing that's going to change my outlook is it's not going to change my outlook so much. I just need price to change. Like I follow price, right? It's so easy to get caught up in the news and you know, are we in an official recession or not? I really just remove all of that. And if price, like right now, we're actually in a bit of a bullish phase. The long-term chart is a buy signal. The markets are holding up. They actually look like they're primed and ready for a half decent rally. So I am bullish right now in the market. And for all we know, maybe we start a whole new bull market that lasts another 10 years. The nice thing is, I don't really care. It really doesn't matter because if we're long the markets and it keeps going up and up, we're just going to ride it higher. If banks start to default, we have this default crisis, debt ceiling, and things break down. I mean, from an opinion, I think it's a very bearish thing, but who knows what the market does? So none of this stuff changes my opinion. It really comes down to price. And the reality is the only thing that all of us get paid for when we're investing is if the price of our asset moves in our favor. So I don't care what the news is around it.
I guess it depends on your time horizon then. So let's say if somebody has a 6-month time horizon to the end of the year, and they say to you, Chris, are you more bullish or bearish for the next 6 months? How would you answer that?
Yeah, I would be bearish. I mean, I think the markets will probably be lower in 6 months, but I mean, that's just a guess. I hate kind of guessing and pushing that stuff out there because the reality is people will now want to jump into a position saying I'm shorting here. I feel like it's Chris says it's going lower. I get it all the time. I get hundreds of emails of you said in this interview gold is going here or here, right? So I hate to forecast because it goes against everything that I do. I like to share where I think it's headed, but people don't take that as I just think that's where it's going. It doesn't mean it's going there. And the odds are it's still a coin toss. That's why I like to follow price. So that's the big thing is I try not to, I mean, I think we're going down a lot lower going forward, but we still might rally another 5, maybe even 10% from here. And that's not something that if you're on the wrong side of that, that's a huge move. And then people, will get hurt that way. So that's kind of the take is just follow price. Don't try to pick a top. I've got a lot of people have told me like how much they've bet to the downside and how they're underwater. And, they're like, well, you keep saying the market's going to have a huge correction. I'm like, I'm just, it's an opinion. It doesn't mean that it's happening. So it's tough.
Mm-hmm. Now, let's talk about TLT. This is a market that a lot of people would like to learn a little bit more about. Bonds. TLT has had a rough year, but we're at a point where the Fed may reach an inflection point, which could cause some interesting repercussions to the bond market. So, what is the price telling you right now?
Yeah, so the bond market does have a pretty interesting price action. Obviously, we had the COVID spike. It has been in a pretty big bear market. It feels like it's trying to put in a pretty major bottom here. But we just need to be aware that more or less the trend is down. It can create these consolidations and then have, this could still just be a consolidation at this point and we could go lower. But when we look at the chart of this is the bond futures. But it's how TLT moves. And I was showing this to subscribers this morning of this kind of resistance area. There's support level and where bonds are flirting with. So bonds are on the verge of, or they're starting to break down right now. we had one day where bonds moved huge, started to put in this topping phase or this consolidation, and now they're starting to break down. And, if you take a look at kind of the height of this topping phase, usually that is going to be the amount of the breakdown if it takes place, which also happens to be this 1 day bar. So if bonds can move up in 1 day, and then couple with that, the volatility in this topping phase happens to be the same stage, in 1 day, we could see bonds have a very big drop and wipe out this whole phase. So I'm a little bit bearish on bonds because they look like they're topping, they're breaking down. Potentially bonds are going to fall. And that means we have been seeing recently when stocks go up, bonds go down. So if bonds are going to break down, which they are right now, that means the equities market is on the verge of popping and having a rally. So that is kind of what I'm looking at. And, I think a lot of investors have piled into bonds in this whole area right here, anticipating rates to stop going up, for rates to start coming down. And when that happens, bonds are going to have a huge rally. But I think investors are a little early into this game. They've been accumulating, expecting it to happen. But the market has a way of dragging things out way longer than you think. The Fed always has a way of, dragging things out longer as well. And I think bonds are going to come potentially back down to this level very quickly. And money might flow back into stocks. We are seeing growth stocks do very well. They're holding up. The NASDAQ keeps pushing higher. And when we look at just a few of these sectors over here, these top three sectors are defensive, protective kind of sectors: utilities, consumer staples, and healthcare. They're down, and we're seeing like the NASDAQ and tech stocks doing very well. So people are moving out of the safe havens, bonds, defensive sectors, and they are slowly creeping into getting positioned for another rally in the stock market. So, it's looking positive here for stocks, negative for probably bonds, defensive stocks, and potentially precious metals could fall pretty sharply with this next rally in the stock market.
Finally, let's talk about gold. One of the questions I've gotten from actually one of my viewers is why the gold price has been trading near all-time highs, yet the gold miners have not. If you look at the GDX, for example, which is a basket of the largest gold miners, it's at 50% lower than its all-time highs in 2011. So that's an interesting divergence. Tell us about that.
Yeah. So if we look at this monthly chart of gold, and you and I have covered this quite a few times here, gold got up into this almost 2100 level, put in a reversal candle, did the same back over here in 2022. And now we've got two candles that are looking very bearish, meaning price ran up, and by the end of the month, it sold back down. And this month, we're seeing the same thing. It pushed even higher. It even broke this previous high. And now it is actually on the verge of closing on the lows. And when you have two candles like this with these long upper wicks, they can be called tweezers or topping candles. That's almost like a little double top. And it's usually a sign that the next bar, the next two or three candles could be to the downside. So, gold to me is doing very well and holding up very well simply because it is a global, low risk kind of safe haven play. A big day in gold is like 1.5%. So it is something where you can put more capital in because it's a slower moving, kind of a safer asset. It's also not, it's a global asset, meaning people in every country naturally think of gold. If they want to diversify and they get nervous, they're like, I'm going to buy some gold. It's the first thing that comes to their mind. So there's a natural steady flow of people, I think, moving into gold, and it's holding up very well. Whereas you're saying how the miners like GDX, GDXJ, they're down like 45, 50% from the highs, while gold right here is trading at all-time highs almost. Those are speculative trades, and people aren't willing, big money isn't willing to go into those high-risk, fast-moving little kind of rockets just yet. And the fact that they're underperforming is a sign to me that gold's not ready to break out. And I still think we're going to see another pullback in gold, whether it's to 1800, 1700, 1600. I think we're going to see metals and miners continue to pull back until the stock market has this kind of financial reset. and it's going to reset everything. We're going to see all asset classes probably get pulled back. And when that happens, I think gold, silver, and miners are going to become amazing opportunities. They'll probably be the first kind of sector, the area to bottom. And we saw that in 2009 as well. So the time is coming, but right now I think gold and miners have got a lot of headwinds still. It's going to be a rough ride for potentially 6 months or longer.
And finally, let's talk about your book, Asset Revesting. We've talked about your philosophy. Do you share any personal anecdotes of trading in your book about some of the mistakes and the lessons you've learned that you can share with us today?
Yeah, so I did publish 2 books last week, which is Asset Revesting, the one you just mentioned, plus the second edition of my Technical Trading Mastery. More or less in Asset Revesting, I don't think I shared too many stories. I know I shared some stories in it, but more or less to the explanation of how I kind of came around to this style, excuse me, this style of investing, which is about protecting capital. And that really is the key. So asset revesting is all about only holding assets that are rising in value. And if something starts to go sideways, loses its momentum, or goes down, it steps aside. It looks through the lens of an asset hierarchy. So whichever assets you favor, you can build your own kind of hierarchy, and then you can move your money to that asset if it is going up. And if there aren't any assets that are stable or rising, then you simply move to cash. And that's what this strategy is based around. It's all about managing your financial risk. And if you just protect your capital, the profits will take care of themselves. And where people get caught up, what you mentioned earlier, is sometimes the market is going to outperform your strategy and you'll feel like you might be getting left behind. But that's what comes with risk management. You're always a little bit behind the ball when a trend reverses, but once the trend's in place, you do exceptionally well. And when the market collapses or falls, you can benefit dramatically and make money by leaps and bounds while everybody else is losing their shirts. So there's always hot streaks or hot times for strategies to work and times when they're going to underperform. It doesn't matter if you're a day trader, a long-term investor, it's going to happen with every strategy. It's just when people are in that situation, they always feel like they're getting left behind. And these books try to explain the problems around the buy and hold strategy, the mindset and the expectations of the markets. And if you have the proper expectations, these markets are like watching paint dry. I tell that to subscribers all the time. Once you know how they move and why they're moving and how to identify trends and reversals, and then you apply like an asset revesting strategy where you're only holding things going up, it really seems pretty slow, pretty boring, and it frees up a lot of time. And that's what subscribers always say. It's like, oh, it's painfully slow, but it's incredible, right? So that's what the books are kind of based around, is teaching you the markets, what to expect, how to identify them. Like the Technical Trading Mastery book, the second edition, I cut the book in half. I rewrote a lot of it. And I actually provide two of my core foundational strategies in there, momentum trading and like a swing trading strategy, with my indicators, my values, and how you can go about kind of managing those positions. So I'm really trying to give everybody what they need so that they can protect themselves. If we do get this big stage 4 kind of financial reset over the next year or two.
Perfect. All right. Well, Chris, congratulations on the book launch. Best of luck with the next book that you're writing. I'm sure you're working on another one down the line, and we'll talk about that when that comes out inevitably.
All right,
thank you very much for being on the show today.
Hey, always a pleasure, David. Take care.
And thank you for watching the David Lynn Report. Stay tuned for more.